Hey, friend, welcome back to the Live Off Rents show, where we bring in real estate, other financial experts to help you build passive income, create your dream lifestyle, and reach financial independence. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I am on this journey with you, trying to hit all those goals that we just covered. And every week, we sit down with a different guest expert. So today, I am super excited to introduce our guest. In addition to hosting the popular Weiss Advice podcast, Yonah Weiss is an expert on using cost segregation studies to lower your taxes as a real estate investor. So, Yonah, welcome to the show.
Hey, thanks so much, Brian. Great to be here.
Absolutely. So, the place that I usually love to start with every guest is just how you got started in real estate in the first place, because these always end up being unique and fun conversations.
Oh yeah, and it's a long story, so I'm not going to get too into it. But I was a teacher for about 15 years, and
Ah,
yeah, at a certain point, I had kind of like a I don't know, a midlife crisis. But we had like a very serious health crisis in our immediate family, and it kind of shook my world up at the time. This was about close to 10 years ago, and I realized I needed some other sources of income from my teaching salary, which wasn't much and still had, student debt and all that kind of stuff going on.
sure.
So, I really just reached out to friends and acquaintances and said, hey, what should I do? Open to kind of anything. And real estate kept coming up in conversation between different friends and acquaintances of mine. I ended up meeting a friend of mine almost, kind of haphazardly, randomly in a parking lot. And he's like, hey, why don't you come work with me? And he was a mortgage broker, a commercial mortgage broker, and had owned himself several multifamily rental properties that he, self-managed. And I was like, okay, great. Yeah. And started learning everything there was to know about commercial real estate through that, basically apprenticing this very experienced friend of mine. And that was really my forte into real estate. We ended up doing, like I said, mortgages, hard money loans. We ended up doing some fix and flips of single family rentals together. And then we branched off. He went off, started his own company. And then I ended up starting working with Madison, the conservation company. And a lot's happened since then, but that was how I got started.
Wow. So, it's funny you mentioned that you were a teacher. So my wife is a school counselor, and we live overseas, and most of our friends are actually through her job, right through the school. So most of our friends are actually teachers.
Hmm.
So I certainly know that lifestyle well. And not to go down a rabbit hole, but my wife and I actually, we aim to live entirely on her teacher's salary. School counselors get paid basically the equivalent of a teacher.
Right.
And then we try to save and invest all of my income. But yeah, so I certainly know how that goes living on a teacher's salary. And especially if you're living in the States, that can be challenging. But so it sounds like you actually, when you got into real estate, you did a lot of different, so fix and flip and rentals, and yeah. So I love that. Hard money lending. I got my start in real estate on the hard money lending side as well. So tell us, so you now work with a company that does cost segregation studies. So a lot of our listeners are not familiar with what those are, how they work. So let's just walk us through the basics of what they are, how they work, and why people bother to do them in the first place.
Sure. So cost segregation is a weird name for accelerated depreciation. And essentially, it's an advanced form of depreciation. Now, depreciation, a lot of people know what it is, but many people actually get it misunderstood because it sounds like a negative thing, right? Depreciate, my property is going down in value. When it's not so, it's actually just a borrowed term. It's the name of a tax deduction that the IRS gives you anytime you buy a property besides for your primary residence. If it's a rental or business property, investment property, you're able to literally deduct the entire value minus land, a certain small portion of that, but essentially the entire value of that property, you're able to write off from your income taxes just because you bought it. Now, it happens to be you can't do it all at once, right? It's over a long 27 and a half or 39-year period, very kind of random, arbitrary numbers. Cost segregation is a way to accelerate that depreciation. So instead of waiting this really long time and just taking a little bit every single year, we're able to, through an engineering study of the property, breaking down its components and showing how certain components actually depreciate faster. So it used to be called component depreciation, which makes a lot more sense. We're
It
saying,
does make more
hey,
sense.
right? Like, hey, the furniture and the flooring and the countertops, all that depreciates on a 5-year schedule. And we're able to identify that and take that write-off at a faster rate. And so think of it like this. you have this pool of potential deductions, right? Because you bought this property for, let's say, $1 million. And instead of taking a little bit every single year, you're able to pull from that pool of potential deductions to take a big lump sum in the first year or the first few years. So I like to think of it like a cash flow mechanism for investors, right? You have this opportunity to take these extra deductions and essentially pay little to no income tax during those earlier years, which is a great way to help you scale.
Yeah, so we run a passive real estate investment club, and one of the things that we talk about all the time is the idea of a lazy 1031 exchange, where
Hmm.
you have a year when an old syndication sells and you get paid out, which is great, but then you get hit with a big tax bill. If you just reinvest that money in a new deal, then largely because of that cost segregation study and because of bonus depreciation, you get a
Hmm.
huge on paper loss to offset some of those gains, right? You don't have to jump through all the hoops of a traditional 1031 exchange, hiring the qualified intermediary and the tight timetables and all that stuff. So yeah, I want to dig in a little bit deeper because for a lot of real estate investors, these are kind of new concepts.
Yeah.
The idea of not just depreciation, but also what that looks like on the back end with depreciation recapture. And just to before we leave the concept of a cost segregation study, one one way that I found it helpful to think of that when I first learned about them and what they were was just going in and reclassifying as much of the building as possible
Hmm.
into other tax categories that you can depreciate a lot faster, right? Like you
Right.
said, 5 years, 7 years, maybe 15 years in some cases,
Right.
instead of the 27 and a half or 39 years. So let's talk a little bit more about depreciation and how that works. Both for what you're doing, cost segregation studies, also bonus
Hmm.
depreciation, which is phasing
Right.
out, but maybe not, depending on that law in Congress that is in limbo. And then also how to manage the depreciation recapture on the back end and what that is, because it's a source of confusion for a lot of investors.
Absolutely. Yeah. And there's a lot to unpack there. But essentially, what we look at is we're thinking about conservation as a tax strategy. So it's certainly great for some people, not really good for everyone. And there are certain scenarios, like if you're selling a property after a very short period of hold, like a year or two, and not doing a 1031 exchange, you're going to be hit with this recapture tax. Now, let's talk about that first, because I think that's will help us to understand the rest of it. Anytime you sell a property, you are faced with a capital gain tax, which everyone is familiar with. If you make a profit on the sale, you're taxed on that amount of profit that you made. Similarly, when you take depreciation as a deduction, and with cost segregation taking a larger amount of depreciation in the earlier years, you're faced with what's called recapture tax on the sale of the property, and it's considered a capital gain, like an unrealized gain. Now, it does not mean, which a lot of people kind of misunderstand, it does not mean that you pay back the depreciation. So if you take, $100,000 of depreciation deductions, you do not pay back $100,000 upon sale. You are taxed on that 100,000, and it's a blended rate of different a combination of three different rates without getting too complicated on that. But it is something you certainly have to consider and put into your business plan in terms of how to face that on the back end. Now, there are several techniques or other strategies to combine with cost segregation in order to either defer or even eliminate or offset that recapture tax. And the most common one, as you mentioned earlier, is the 1031 exchange, where you are deferring not only your capital gain tax, you're deferring that recapture tax as well. You mentioned the lazy 1031 exchange, where by doing a cost segregation on one property and getting a large amount of depreciation, you can use those losses not only to offset your income, but also to offset the gains from the sale of another property. And so that's something that can be done as well. There's another really great strategy. I'm not sure if you've spoken about it too much on this show, but it's called opportunity zones or opportunity funds, and that is a relatively new. It also came out, same thing with bonus depreciation, came out in the Tax Cuts and Jobs Act back in 2017, and essentially is a formula to defer or eliminate capital gains taxes. And so combining that with a conservation study, you can invest in certain areas in the country that, each state has designated as zones that are fit for redevelopment. And therefore, by investing in that area or that zone, you're able to completely defer or even eliminate your capital gain and your recapture tax as well. So there are some other strategies as well, but those are the main ones where we're able to, wipe that out. And with that being said, you mentioned bonus depreciation. I'll just touch on that very briefly.
Please. Yeah, yeah.
Essentially, once you've done a cost segregation study, and as you mentioned, what we're doing is allocating certain components of the property to 5 years instead of that 27 and a half. 5 years can include anything that's non-structural. So you think about like furniture, appliances, fixtures, even things like the flooring, countertops, cabinets, window treatments, even millwork and things like that. So there's a lot and a lot more things, but essentially anything that is non-structural is going to go into that 5 year category and can be, depending on the type of property, on average 20 to 30% of the actual property value is found in those 5 year components. There's also the 15-year category, which is land improvements like landscaping, pavements, concrete, if you have a swimming pool or the concrete there, fencing, anything outside, essentially. Once we've identified the 5 and the 15-year property, we're able to take bonus depreciation allows us to take a lump sum of those deductions in the first year. Now, it used to be 100% bonus depreciation. That was from 2018 through 2022. Now, in 2023, it went down to 80%. 2024, down to 60%, which means you can take 60% of those deductions, of those accelerated deductions in the first year. So you're getting a big lump sum up front. And it may come back. There is a bill in Congress right now that has yet to be passed fully by the Senate, but there is good news that it is being discussed in order to reinstate the 100% bonus depreciation, which obviously is a great tool to kind of, it stirs the economy, giving more benefits for investors to reinvest, et cetera.
So much that you covered there. Yeah, no, I love these tax strategies because the more money that you can keep in your own pocket and keep investing, the faster you can build wealth, right? Rather than
Absolutely.
losing it to Uncle Sam. Um, one question that I hear people, real estate investors, struggle with again and again is, there's this misconception that if people don't actually deduct for depreciation on their tax return, that they won't have to pay recapture tax when the property sells. And I see you shaking your head. I learned myself not too many years ago that is not true. So
The
yeah,
hard
walk us
way.
through that, will you?
Yeah, the hard way. Yeah,
Yeah.
the IRS considers it as if you took the deduction, even if you didn't. So, which means you'll be hit with the recapture tax on the sale, even if you never took the deduction. So, obviously, it's a good idea to take the deduction. And in general, any accountant that I've ever spoken to that, has any credibility says that the first thing you're looking to do is deduct or defer. Like find as many deductions as you possibly can and defer as much as you possibly can, because what we're dealing with is in the now, right? Unless you expect to have a much higher tax rate, maybe next year or something. But essentially we're focusing on the now. How can we reduce our taxes this year? So yes, you have this depreciation deduction even without cost seg. Depreciation of itself is amazing. In fact, for many residential properties, long-term rentals, for example, if you have a mortgage, you have things like that, the regular, ordinary, what we call straight line 27 and a half year depreciation is usually going to be enough to offset any of your passive or any of your rental income. So oftentimes you won't be paying any taxes just by taking that deduction and the other deductions that are allowable.
Now, does your company do like cheap cost segregation studies for like single family rentals, or do you only do the more comprehensive, apartment building kind of cost segregation studies?
So we only do what's called what the IRS calls the quality cost segregation study through an engineering approach, which means it is a little bit more expensive. We do them for single families, for any type of property, really. We're the biggest national cost segregation company, so we're doing literally every asset class out there, from office buildings to industrial, self-storage, mobile home parks, you name it. But it is a little bit expensive, so it's probably a few $1,000s minimum. Whereas, as you alluded to, there are some of these software do-it-yourself type
Right,
costings
like the
that are available.
self-reporting. Yeah,
Exactly. Now, those don't necessarily hold weight in terms of an audit, and so therefore they are a little bit more risky. However, I've heard from some accountants that, if you are, have just some single families, very low tax basis, then it may be worthwhile. Now, I highly recommend anything purchased for over $200,000 is usually the regular engineering cost tag is still well worth it. Meaning, even with the cost of a few $1,000s, the after-tax benefits of the study is usually going to be, 10x of what the cost would be. So it's certainly going to be worthwhile.
Yeah, and that's a good rule of thumb that you shared there. Because yeah, I've seen some like single family rental investors have success with sort of the DIY like self-reporting cost seg studies. But again, it not as detailed, doesn't hold as much weight as doing a proper like engineering inspected cost segregation study where someone
Yeah.
physically comes out to the property. Uh, so I want to hear a little bit more about your current real estate investing strategy and how things have changed for you over time and how your investment strategy has changed in real estate as you've learned more and as you've matured in the industry.
So, I've done a lot of different things over the years, but currently my investment strategy is mostly as a passive investor, as a limited partner, in several different deals, including multifamily, mobile home parks, RV parks, self-storage, one retail property as well. And that's really been, just as I've evolved as an investor, and I have a family, 6 kids, and so I did, do some active investing and worked even on one deal as a general partner in a multifamily deal. It was a little bit more than I wanted to spend my time doing. And, thank God I really enjoy what I do with the cost seg. And so I want to focus my time doing what I enjoy doing and what I'm good at, as opposed to, doing other things. So I rely on very skilled operators who own and do well in terms of the investing, and just hand my money over to them and help get some wealth building through that.
Well, I that certainly resonates with me, and that so I used to own dozens of rental properties back in the day in my youth, my misspent youth, and I hated being a landlord. I just absolutely hated it. So, at a certain point, I got rid of all my rental properties and now, like you, I only invest passively in real estate. And in fact, that's
Hmm.
actually why we created this an investment club that we run every month is that's what we do. We bring in different sponsors and we all vet these deals together and, just wire the funds and then forget about it. So, yeah, it's a much lower stress way of investing.
Yeah, I mean, listen, it certainly can be. There are scenarios where it doesn't go all well, and not every investment is all roses. But if done right, it's certainly the right way to go for a lot of people.
Yeah, absolutely. And, when you can find ways of investing smaller amounts in syndications, then,
Hmm.
again, you can keep it lower stress where at the end of the year, it just becomes an average of numbers on the page, how your portfolio is performed, as opposed to having to put 50 grand, 100 grand into a single syndication deal and then like gnawing on your fingernails about how that one deal is performing. So it's a recurring theme that my partner and I talk about all the time.
Yeah, absolutely.
So, Yona, if people are interested in working with you and in hiring your firm to do a cost segregation study, or if they're interested in your podcast, how can people connect with you?
Well, I'm very active on all the social media platforms, so you can definitely find me there. Most active on LinkedIn, Twitter, Instagram, you name it. But you can also go to yonahweiss.com, which is just my website. It tells a lot about not only my our company, Madison Specs, but also the podcast, Weiss Advice, and what else we're doing in the investment space as well. So please feel to reach out and happy to help.
Awesome. Well, Yona, thank you so much for coming on the show today. This was a lot of fun.
And thank you, Ryan. It's been a pleasure.
Absolutely. And guys, if you enjoy these conversations that we have, please rate, review the show. Makes a world of difference to us. And we will catch you next week, same place, same time. Bye now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have averaged returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment. which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rental's Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.